Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It's just general in nature only. Lots and lots of talk, and that's what it is. Plenty of talk coming from the Fed. In fact, last week we saw 17 different speeches being made by Fed members, and they were varying in a huge amount of degree. What was clear though, that they are probably all singing from one hymn sheet. Rates are rising, that's a given. They're all close to consensus on the idea that the balance sheet needs to be looked at. But then from there it starts to get divergent. And you say, we'll have somebody like Jamie Bullard, who is incredibly hawkish, remains incredibly hawkish in terms of where he stands. And he was very strong again last week about the idea that the Fed is behind the curve. It needs to go hard, go fast to really try and contain inflation, bring it back in. You also have someone like Loretta Mester, who talks about front loading the whole scenario to basically make sure that by December they're at 2.5%, but bring it forward and doing it now. She's the other major hawk out there. But then you've got somebody like Ralph Bostic. You've also got someone like Neel Kashkari, for instance, who are known doves that have completely molted those feathers and are now hawks. Someone like Neel Kashkari basically, in his words, said, I've penciled in 7 rate hikes for my look on how things are going in the US. And then you look at somebody like Ralph Bostic, who is saying the same thing, but also probably that it's actually going to be harder than that, and is open to the idea of a 50 bip rate hike and a harder move on balance sheet. That's an amazing thing to be saying and standing here, considering how dovish those people have been over the years. But let's be honest, it's all about one person, and that's the chair. And Powell was definitely harder than what the market had expected. He personally singled out that inflation is now too high. He even put his hand up to some extent and put the white flag, saying that they have got it wrong around inflation, and that the idea that we were going to see supply chain disruptions ease and therefore you were going to see inflation abate could be actually off the cards. And even with that, we are now at a structural point. We've been talking about that for a year and a half. So where did that all mean? Well, it actually knocked the US dollar all around, because it's a known. There wasn't still enough consensus out there to say that a 50 basis point rate hike is coming and therefore a really hawkish tone. It was all known. So you look at something like euro dollar, it was basically up and down all week, and it finished about 110, got down to low 109s, got up to the high end 1010s, but in the end, nothing to really write home about. Looking at also something like, you've got cable, which also sort of rose through the week, which is interesting, because somehow at the moment the pound has been seen as like a safe haven in Europe. That's just not true. That'll get shaken out pretty quickly. And then you look at the Aussie dollar. The Aussie dollar went through 75 US cents, and that hasn't been seen since the end of last year. It is a commodity story. There's no doubt about that. You are continuing to see that with the iron ore price. You're continuing to see it with overall bulk commodities. They're doing very, very well. And that is why the Aussie is back that level, possibly justified to some extent. And then the unknown quantity about when we in this country will see rate rises. But it will be interesting because there is no known here, which is the balance sheet. The balance sheet unwind is a known selling position. And that may explain why at the moment there is this idea that maybe that sort of big push that's been going on the US dollar could come to an end, which makes me finish on one thing, which has to be dollar yen. It is the only currency pair out there at the moment that continues to trade in a fairly realistic idea and pattern. It is following US real yields to the hilt. It made a 7-year high last week at 122 yen. That is an amazing thing to talk about, and it has been something that I've been happy and proud to say that we've been part of for the last 6 months. It's gone from 104 all the way up to 122, and that change hasn't happened, and it is because of the US real yields, and that story isn't broken, and it's the only pair that you can see that has some rhyme or reason to it.